Capital markets are venues where savings and investments are channeled between the suppliers who have capital and those who are in need of capital. The entities that have capital include retail and institutional investors, while those who seek capital are businesses, governments, and people. Capitals are composed of primary and secondary markets. The most common capital markets are the equity markets and bond markets. Capital markets seek to improve transactional efficiencies. These markets bring those who hold capital and those seeking capital together and provide a place where entities can exchange securities safely. An equity market is a market in which shares of companies are issued and traded, either through exchanges or over-the-counter markets. Also known as the stock market, it is one of the most vital areas of a market economy. It gives companies access to capital to grow their businesses and investors a piece of ownership in a company with potential to realize gains in their investments based on the company's future performance. Substantial regulatory barriers separate national equity markets from each other. Regulatory barriers make it difficult for a corporation to attract significant equity capital from foreign investors. These barriers tumbled rapidly during the 1980s and 90s. The global equity market enabled firms to attract capital from international investors, to list their stock on multiple exchanges, and to raise funds by issuing equity or debt around the world. An interesting consequence of the trend, international equity investment, is the internationalization of corporate ownership. Today, it is still possible to talk about U.S. corporations, British corporations, and Japanese corporations, primarily because the majority of stockholders of those corporations are of the respective nationality. However, this is changing as U.S. citizens are buying stock in companies incorporated overseas, and vice versa as foreigners are buying stock in companies incorporated in the United States. As the business world becomes more globalized, companies now have the ways to access cheaper sources of funds and financing outside of their country of operations. Instead of relying on investors in their own domestic markets, businesses and governments can tap into the pockets of global investors for much needed capital. One way, though, which companies can access the international lending scene is by issuing international bonds. A global bond is issued in a country and currency that is not domestic to the investor. From the perspective of a domestic investor and resident in the United States, an international bond is one that is issued by corporations or governments in other countries denominated in a currency other than the U.S. dollar. These bonds are issued outside of the United States and are generally backed by the currency of the native country. A global capital market benefits both borrowers and investors. It benefits borrowers by increasing the supply of funds available for borrowing and lowering the cost of capital. It benefits investors by providing a wider range of investment opportunities, thereby allowing them to build portfolios of international investments that diversify their risk. The global bond market has grown rapidly over the last 4 decades. Bonds are an important means of financing for many companies. And there are 2 types of bonds, foreign bonds and euro currency bonds. Foreign bonds are sold outside the borrower's country and are denominated in the currency of the country in which they are issued. Many foreign bonds have nicknames, like U.S. bonds are known as Yankee bonds. Great Britain bonds are known as Bulldog bonds. Japanese bonds are known as Samurai. Euro bonds are normally underwritten by an international syndicate of banks and placed in countries other than the one in which the currency is denominated. For example, a bond issued by a German company, denominated in U.S. dollars and sold to investors outside of the United States by an international syndicate of banks. The attraction of the euro bond market is 1. The absence of regulatory interference. 2. Less stringent disclosure requirements than most domestic bond markets. And 3. Favorable tax status. For the global finance leader or manager, the growth of the global capital market has created multiple opportunities for global businesses that wish to raise funding or invest funds outside of their own domestic market. Global companies are often able to borrow in a foreign capital market to obtain funding at a cost lower than is possible in a purely domestic capital market. However, with such opportunities come greater risk, as the global market is not regulated, and there is a greater possibility of foreign exchange risk. Yet firms, institutions, and individuals realize the need to diversify their investments in order to limit their risk or exposure.